Bunch of changes coming in for superannuation in the new financial year, so check out today's episode to catch some of the ins and outs. Mate, February AWOTE figures came out, I think it was yesterday. Triggered a few changes. Scott, have you seen what's out and about?
I think we've got a rule in our office about calling the thing. So can we kick off by what AWOTE means, please?
Oh God, what is it? Ordinary, average wage, average.
This is the reason why interest rates have gone up.
Average workers' ordinary time earnings?
Earnings, yeah. Average workers' ordinary time earnings. So what the government does, it releases the stats on a fairly frequent basis on what the average employee is earning. And there's a few really interesting things. First of all, those working in public service make way more than the average person working in the private sector. There's something interesting. It also showed there was about a 4% income rise in the last 6 months for women, which is actually quite a lot. And so those are kind of the key things that I saw when I was looking at that AWOTE numbers. What about you? What were you when you were looking at them, Phil?
I actually didn't look at them at all, but I was just watching with interest because really it was just going to give us an indication of whether we're going to see an increase to the superannuation contribution caps for next year, and it looks like that will be the case.
I saw some really interesting things about how, so these ordinary wages is used to calculate a lot of things, and the RBA really takes those into consideration when they're looking at interest rates. So if you're a pre-retiree or not quite, if you're getting sort of close to retirement age and interest rates are moving up or down, it actually benefits you because rising interest rates means you get paid more money on your cash, which means fixed income products have to pay you more money. If you're an investor, you actually want higher interest rates. It also adds to a stronger Aussie dollar as well. So we're able to import goods into Australia at a lower cost. So food, fuel, agricultural products, etc., come in at a lower cost because we've got a stronger Aussie dollar. And it's kind of a weird thing. It's just like, think of those people that are struggling to try and pay their mortgage. Let's make it harder for them to pay their mortgage because the economy has gone up and everyone's earning a bit more. That's how the world works. That's what we're in.
Look, it is interesting that we've got a major supermarket in the case with the ACCC at the moment banging on about price rises due to inflation, but then we're also seeing record profit numbers reported. Draw your own conclusions.
Hi there, just jumping in. Thanks so much for watching this video. I've got Jordan, my client liaison here. He's the one you're going to speak to if you've got some questions about if we can help you. Click in the description below. We've got the booking link as well as a score app that'll help you understand where you're at. No obligation. Jordan's much more friendly than we are. He's got some great answers to some of your questions. Look forward to seeing you soon. Thanks. Back to the video.
So I guess what's the point of all that waffle in relation to superannuation rules for the new financial year? There are a few interesting things to watch, but the relation of AWOTE, like we were just talking about, is concessional contribution caps. So if you watched last week's episode, you'll have seen us talk about contribution caps and that sort of thing a bit, but basically how much that you're allowed to put into superannuation and have a tax deduction claimed on. That's a combination of your employer contributions, any salary sacrifice, any personal deductible contributions that you make. This year is $30,000. Looks like from next year we're looking at $32,500. So a little bit of extra space there to throw some deductible contributions in. And the flow through effect of that then is the non-concessional contribution cap. So how much money can you throw into super and not claim a tax deduction, which currently is 120. It's purely and simply calculated as 4 times the concessional contributions cap. Say it's going to go to 130 for the next financial year, which is cool. A bit more space for everyone to throw a few bucks in.
So how's that going to be impacting your advice, or how's that going to be impacting Australians if you're listening to this pod?
It's a great question, actually, and probably links through to another change that's coming in that I wanted to have a quick chat about, because there's potentially some traps in one of these changes that's coming in that this might help with. I actually just had this conversation with a client earlier this morning. So you've seen us speak a little bit about Payday Super. So Payday Super is another rule that's coming in the new financial year, which means that your employer now, currently your employer only needs to make your superannuation contributions once a quarter. And for a lot of people, we see that's the case, regardless of the fact that it tells you on your payslip every week or fortnight or whatever how much it is. They're only paying it once a quarter. So from 1 July, they will have to start paying those contributions in line with your pay frequency. So they've got to pay it, if you paid weekly, fortnightly, monthly, whatever. Now you might be sitting there thinking, Phil, what the hell is the relationship between that and the contribution cap? There's a bit of a sneaky trap in that we've got to be careful. If you are someone who many people we speak to that are getting closer to retirement, that have got a real focus on getting out the door of pumping super contributions in, and if you're someone that maxes your cap every year, you need to be careful here.
Why is that, Phil? Tell me.
If you think the flow through effects of that, so I'm currently, imagine I'm currently getting my superannuation paid quarterly. And my employer must pay those contributions by the end of the month, or so the 27th of the month, whatever the date is, in the month following the end of the quarter that they relate to. So to put that in plain English, for the quarter ending in June, my contributions need to be paid by the end of July. Just imagine I was paid weekly, and now my employer from 1 July has got to start paying my superannuation contributions weekly. But up until that point, they're only paying them quarterly, and they're paying. So that means that in that financial year, I'm going to get my last quarter from the previous financial year's contributions paid in the first month of the new financial year. So that means in that year, with the Payday Super Rules, I'm now going to get 15 months worth of contributions paid in that financial year.
Not great if you are a top income earner, and not great if you're a medium top income earner, because you've actually brought forward a tax obligation or potential tax liability.
If you are maxing the cap, well, then that's likely to tip you over.
So what can I do about it?
Well, get someone to recalculate your contributions would be a start. Have a close look at that. And just make sure, obviously this increase to the cap, the 32,500, might help some people from squeaking over the limit, but you just want to take a close hard look at your contribution strategy for the new financial year. And to be fair, you should do that every financial year anyway, but probably more important than others now. And look, the other potential trap, if you're a high income earner, up around that $250,000 a year mark, so it's only a small subsect of people this will increase, but that could actually push you further into Div 293 territory. So,
hey Phil, what does Div 293 actually mean? What's it relate to?
Anyone that this is relevant to probably already gets a letter every year from the ATO and gets really angry about it, so they're probably familiar. But Div 293, so if you earn over 250,000, and that includes reportable superannuation contributions, so salary plus super, if that goes over 250,000 for the financial year, you pay an additional 15% tax on your superannuation contributions over that amount. So an extra 3 months of contributions dropping into this financial year potentially could push you further into that territory. So it could cost you a little bit of extra taxes.
That also relates to someone who's not just, say, a really high income earner, but if you've got lumpy income and for whatever reason in 1 year you might have a really big spike in your income, there's a chance that this will also affect you. So there is some financial planning options around trying to smooth that in terms of contributions to your super as well. So that's certainly something to also consider.
Yeah, that's right. Got even things like timings of bonuses and stuff that attract extra super contributions. There's a lot of little traps here. So look, we can't give a one size fits all. Here's what to do for everybody, but you might just want to check it out if you're someone that is contributing extra to super or sitting close to those caps. Yeah, so that's a bit of a dicky one.
It is.
I did hear a rumor that supposedly the ATO have come out and said they're going to fix this problem. I don't know how, some sort of magic, but anyway, we'll wait and see what happens. I love it how they legislate first and then think about all the problems afterwards.
Isn't that all why we've got a job though? Like, we will never be out of job because the government can't help themselves. They just keep adding complexity to things.
We'll always rely on dumb decisions from the government. Yeah.
Yeah, and then we're here to try to figure it out and then help our clients to figure that out as the next steps.
All right, so I've covered off on the concessional and non-concessional caps, mate. What do you got for us?
We're going to be looking at capital gains and franked dividends. A few news articles, I certainly saw them yesterday, talking about how they might be changing on property, which I would go on a limb and say I don't think it's going to change anything, because anytime you touch anything related to the property market, you almost always get voted out of government. So that's my thought. I don't know, what do you reckon, Phil? What do you reckon of the CGT on property?
There's a lot of pressure out there. I don't know. It'd be interesting. I wouldn't be surprised if we did see some changes. What they look like, I don't know. Something like a cap on the discount once you get beyond a couple of investment properties or something, I wouldn't be surprised to see. Hey, look, it is difficult to know. You are right. There's a big voter base that would be very upset by something along those lines. But there's also a bloody big voter base now coming up and becoming voters that actually are very upset by the whole concept. So it'll be interesting to see if there is a shift in that voter power, The
thing is, like, capital gains it's like you've got multiple assets, right? So if you're let's say, for example, you're a millennial with crypto capital gains, if there was changes, that would also affect you. Capital gains is levied on any asset that you make money on. And Australians are absolutely over leveraged on property. And if you're anyone outside Melbourne, you're probably sitting on a pretty solid capital gain if you bought 2022 or earlier.
Yeah, 5 minutes ago. Yeah.
Sure. Yeah. I mean, yeah, sure. Sunny Coast Brisbane's gone nuts.
Yeah. Look, it's interesting, but I don't know. Like, I think I'd be surprised if we didn't see any changes if they weren't just quarantined to property. I would be very surprised to see changes leveraged across other assets. We'll have to wait and see. And the other interesting thing will be, okay, was there going to be any grandfathering? Because it would be somewhat unfair if you've based, even your retirement plans around your investment portfolio that you've been building for the last 20 years and all of a sudden have the rules change right at the finish line. Often we don't see that. Often we see grandfathering, but, I've been surprised before.
When Phil uses the word grandfathering, what they do is they basically, it's the concept of pulling up the ladder behind us. They'll create a rule for other people and then they'll have the rule for themselves. And this occurred when capital gains was first introduced in November 1986. Or was it October 86? And this is a relevant date because any asset that was purchased before that is CGT exempt, and any asset that was purchased after that in relation to property or whatever it is has a capital gains tax levied on it. So when they put that in the late 80s, they said, no, capital gains tax doesn't relate to you people. It's just you younger people that are coming through. You're going to cop it. And that's the example of grandfathering, which we have a precedent for that occurred 40 years ago.
And you look at super and a lot of like old account-based pension changes and all that sort of stuff. There's a lot of grandfathered rules kicking around there still. Yeah, look, it'd be an interesting one to watch. And I don't know. I don't know what'll happen. It's just such an interesting thought experiment to think it through and whether it's actually going to make problems worse or better as well. I mean, there's solid arguments either way. It'll be interesting to see. If the intention is to cool the property.
Yeah, I think it's like, look, this, when other commenters on this, but it's in my view, it's very clearly the problem is supply is so restricted. And if we looked at they showed the Productivity Commission came out and there was a report came recently, and you see the productivity gains in construction and housing is one of the least productive industries in the country, and it's actually a global thing as well. There's probably a lot of factors in it, maybe strong unions, maybe it's just a dislocated type of industry because you actually physically got to get someone to go sit there in the rain and the mud and actually build it. But I really do like watching the TikTok inspector with all of the non-compliant things he finds on new builds.
Yeah, that's pretty funny.
So I think that, that's an industry that's ripe for change as well, just to increase supply.
It is interesting. So you think probably how much labour got sucked out of the building industry and into government projects, off the back, a lot of the stuff that came off the back of COVID, trying to keep people working and all that sort of gear, and flow-on effects especially up north here where we've got, so many people sucked into building stuff for the Olympics. Anyway, we can debate the pros and cons of all that till the cows come home. We're not going to solve any problems.
Let's wrap this episode up.
I've got more to talk about.
We've got non-concessional caps coming in. We've got changes coming in non-concessional caps. We've got changes to the total super balance. There is things we're looking at, capital gains tax on property. Phil, what else are we wrapping up?
Yeah, look, Div 296 is back in Parliament, which is an interesting one. So Div 296 for everybody is, you'll remember everyone jumping up and down a little while ago about the tax on superannuation balances over 3 mil. And that sort of all went by the wayside for a bit. It's back, but it looks a bit different now, and it's an interesting one. So now what it looks like, instead of an extra 15% tax levied on growth in funds that have a balance over 3 mil, we're talking about an extra 15% tax on balances over 3 mil up to 10 mil, and then extra 10% beyond that. So 40% tax on earnings in super funds over 10 mil. Obviously not too many of those around, but some exist. And it's funny that, one of the big things I think there was a lot of uproar about and people were getting concerned about was that effectively it was going to end up taxing unrealised capital gains the way it was sort of proposed. So there was a lot of uproar and concern about, okay, well, this is a slippery slope. If they start doing it in super, what's going to happen elsewhere? That's no longer the case. Now it's only going to be taxed on realised capital gains. However, just think about if you're the accountant sitting at Australian Super with $300 billion of pooled funds under management. How the hell are you supposed to manage that? It is actually going to be phenomenally difficult, and I've seen some presentations talking through some of the stuff that these funds are going to have to calculate, and man, I'm glad it's not my job. I don't think any of them got a hope in hell.
So what's referring to is that you've got, so these type of funds are effectively just like a large bucket, and they're kind of on a ledger system. It's not actually a true separately managed account, which is typically what we will speak to our clients about, which is the benefits are. You're not having other people triggering tax consequences, or having other people move in and out of the fund can actually have effect on the people that do nothing, e.g. people who panic sell. So as well as also calculation differences. Why did I do it? Historically, it was very easy because everyone just went in the same bucket. But now with technology, you're able to have separately managed accounts. I don't know. They'll figure it out.
Yeah. So it's going to be a super interesting one. I'd hate to be a bean counter at a large fund and having to deal with that one. But for the rest of us, if you've got a self-managed super fund, it's also going to be a problem because you're going to need an actuarial certificate. Look, if I look at most of our client base, we're not talking to a lot of people that got north of 3 million super. There's not a lot of them out there. So you're probably all sitting here listening will feel, why do we actually care? Too bad they can pay the extra tax. And yeah, fine, that's okay. But why we all should be worried is there's going to be a hell of a lot of extra work for funds here, self-managed funds and large funds, and that cost's going to have to be footed by somebody. If you're a large member-owned fund, who's paying the bill? The members. So, yeah, I don't know. We're just going to have to watch and see how this plays out, but it's definitely a concerning one.
I think it's also important to say, well, it's, why does it relate to me as well? If maybe if you're 40 or 45 and you're saying, well, there's a chance your fund will get there. Like if you have this invested correctly, and also when you turn 65, 67, you don't automatically take the entire balance out. Like you let that run. So if we're looking at a timescale of like 30 years or maybe 35 years and you keep contributing, didn't they say like this tax will hit every single 21-year-old? Or like something like that?
Yeah, and the initial proposal had no indexation. I actually haven't seen any word on indexation under the new proposal. So it'll be interesting to see how that plays out. It is something to watch. And one other tangible thing for a lot of people to worry about that I've got in the coming up rule changes as well. Just talking about going back to the non-concessional cap increase, so they're going from 120,000 to 130,000. If you are someone that's used the bring forward rule, so the bring forward rule means that you can bring forward 3 years of that cap. So right now, sitting here today, I could put 120,000 in, or I could say, I'm going to bring forward the next 3. I'm going to bring forward 3 years, or bring forward the next 2 years. So 3 years in one go. 360,000 I could drop into super today. And I can use that in stages over that 3 year period. It's not, it doesn't have to be 360,000 now. So if I have triggered my bring forward rule right now, so just say I did 150,000 this year instead of 120, that has triggered my bring forward period, which then limits me to 360,000 over this and the next 2 financial years. Now, I do not get the benefit of that indexation of the cap. So I am still limited to 360,000 over this and the next 2 years. I don't get 120 this year and 130 for the next 2 years. That's fine. Like, it is what it is. It's part of just planning your contribution strategies and that sort of thing. But there is a trap here, and there's a trap to be careful of. If you inadvertently trigger the bring forward rule, even by $1, you're losing the benefit of that. So if you've got plans for some significant contributions over the next few years, you need to be mindful of that. One that catches a lot of people out is the old making a contribution to super and then claiming a tax deduction on it using a notice of intent to claim form. And sometimes what people will do is they'll say, okay, I've got $20,050 left in my cap for the year. So I'm going to submit a notice of intent to claim to my super fund to claim $20,050. The super fund will accept that notice. They will process it. It'll go to the ATO and you'll claim your tax deduction for $20,050. The ATO will not provide a tax deduction on cents. They will round it to the nearest dollar. They're going to process your contribution as $20,000 and they're going to apply 50 cents to your non-concessional contribution cap. So if you've then gone and put in 120 grand this year with the plan of doing 360 or whatever next year, you've actually already triggered bring forward. And so you are limited to the current contribution cap for the next couple of financial years. You don't get the benefit of that in indexation. So super, super dumb thing that shouldn't be able to happen. Can happen, happens all the time. Watch out for it.
Guys, I just want to touch on the notice of intent. What that actually means is you'll need to, if you do contribute to if you make a voluntary contribution, notice of intent is a simple form. It's usually in your super fund, or your advisor will help you fill it in. Sometimes people are like, what do we need? So just literally just talk to your advisor, or maybe your fund can help you, but generally it's a
fund will have it going off the ATO website.
Yeah, generally it's a form. Yeah, and you do need to submit it, and you do need to make sure you get that form in so you're able to claim that deduction and notify the government of what you're doing. And it does need to match up with your MyGov profile as well as your super fund. So a couple of things just to be mindful of.
Yeah, and actually just while we're on the topic, even though it doesn't relate to changes, there are a few traps with those as well. One is, like you're saying, it's got to be in. It's got to be in before you do your tax for the following financial year. You can wait till after the end of the previous financial year, which is cool because it lets you work it out to the dollar, but make sure it's in before you de-tax. Also, if you're planning on moving to pension phase or rolling your superannuation over or anything like that, you need to make sure that you've submitted it and that your super fund has acknowledged it. You've got the letter in your hand before you do anything, or you will lose your tax deduction or a healthy proportion of it. So a couple other little things. There's a few bonus tips that for you.
Thank you guys for listening. This is a meaty episode, but with some big changes coming, it's important that you are aware of it. So that's why we put this content together. Please do like this channel. We do see you. We do see the subscribers come in. We really appreciate you following us and engaging with our content. Again, the QR code has come up a couple of times. So if you feel like you would benefit from a chat with Phil or myself, please reach out. Jordan would organize a time, and we look forward to seeing you on the next episode. Thanks, guys.
Awesome. Cheers, guys.